This is Chapter 20, Video 5. Let's launch. Okay, so the learning objective in this video, we're going to do the importance of partnership tax basis and their partnership interests and adjustments that affect it. So I've shot a really good video series, and I've said this in a couple other times in some other videos that I shot a pretty good video on all of this. So what I did is I took a look at tax basis, at-risk basis, and then also the passive limitations in terms of taking losses. A lot of that was shot in that video series is going to be discussed here. And so when we get done with this, it might be a 15-20 minute video, but if you want to get really into the weeds about it and get a better understanding of it, and actually, I think by watching those videos, you're actually going to see a little bit more that might help you on the exam. It's not because I'm going to test something that's specifically there, but I just explain things a little different. And I try to explain it from a perspective of somebody who doesn't have a tax background. So sometimes I get a little bit more to the basic level, which might be helpful for students who are actually interested in learning this. But so during the year, what'll happen is, and this is going to be outside basis. We're not talking about inside basis. And the difference between inside basis and outside basis is basis of the assets in the partnership itself. And that's actually split between everybody. Outside basis is the basis that the partner has in the partnership. So one of the things that'll end up happening when we calculate their tax returns, we're going to look at things that happen within the changes on the K1, and then a lot of times tax software will calculate the basis for you, but it's kind of GIGO, G-I-G-O, which stands for garbage in, garbage out. If you don't put in the right amount of stuff correctly, what'll end up happening is that the tax system's going to, either A, it's not going to track basis correctly, or B, what will end up happening is that the system will look at it and say, hey, this person has a distribution in excess of basis, and you have to pay taxes on it. I remember once this last season, I was working on a tax return, and there was a $14,500 some odd dollar a taxable amount that was showing up on Schedule D, and I'm like, from what? They didn't sell any stocks or anything like that. I looked at it and it was defaulted to long-term capital gains line F, box F checked, and I was looking at the capital gain input, couldn't find it, and I was just scratching my head, kind of trying to figure out what is this? I don't get it. And then I took a look at it and I noticed that it was because the basically what had happened is that the loan amounts hadn't been input correctly in the past year, and then when it rolled over and we tried to enter it for this year, it didn't calculate correctly. Once I got everything straightened out, it took me probably about 30 minutes after I realized what happened, kind of go back, look at everything, and so I had, I talked to the staff, and I had a staff who had prepared it last year, and then I kind of didn't look at it because it didn't matter much to them at that time. But when we looked at it this year, I kind of was like, look, this is living proof. If you just do a little bit of extra time each time you do the tax return, you can actually save yourself an enormous amount of headache and time later on as you're trying to reconstruct. And I can only imagine how bad this would have been had this, been a client for, 10, 15 years, and I'm trying to get K1 so that we can calculate this thing correctly to kind of keep up with it. So what ends up happening with partnership basis is that you are going to have the ability to increase for actual and deemed cash contributions to the partnership. And what that means is, so if I'm a partner in a partnership and I contribute $100,000, my tax basis goes up by that $100,000. Okay, so and that's kind of important to be able to keep track of in order to keep and keep in mind on in all this. Because if you make contributions, you don't want to lose that, because that could save them, potentially what I like to call false taxes that they pay because they shouldn't have paid because they really didn't have a situation that warranted it. So, again, if it's something that you actually manage very well, you don't have to worry about this. Then you also have partners increase for share of ordinary business income as separately stated items and tax exempt income. Now, the tax exempt income actually throws people for a loop. They kind of go, wait a minute, hold on a second. So let me see if I got this straight. If I get $1,000 of my share of the tax exempt income is $1,000, why do I get to increase my basis by it? And here's why. The IRS had a chance to tax it, but due to limitations that Congress has put into the tax code, they didn't. They chose not to tax that. So the client, your client, will actually still get some benefit from that because it was income that was subject to tax, didn't get taxed. They get to increase basis on it. Now, what'll happen is non-deductible expenses will have the same effect. So if I have non-deductible expenses, and and we'll go over that when we get to point 4. You'll have a decreasing basis because of deductions and things of that nature. So it does happen, and it says down there fines, penalties, and etc. It is true. You do have to deduct for that because what the IRS looks at is they said, look, this is a cash outflow that actually took place, and as a result of which it does decrease your basis. So that kind of happens out. Third point, decrease for actual and deemed cash distributions during the year. So if you take $50,000 out of the partnership for yourself, that's a reduction in basis because you've already taken cash that doesn't exist for the partnership's benefit anymore, and therefore it decreases your basis. And as we talked about, point 4, decreased partner share of non-deductible expenses, ordinary business losses, and the separately stated expense and loss items. So cash distributions in the operating partnership. What happens is that you're taxed on income when the partnership earns it, but not when it's distributed. So this is one of the reasons why partnerships for many, many years were very popular over corporations because of the effect of double taxation. So if you take a look at it and you think about it, it actually makes sense. It's tax once, tax at the source. So once you go ahead and you pay the tax on it, you don't get taxed again when you take the money out. And that's actually a very big benefit of owning an interest in a partnership versus owning an interest in a corporation that might be paying out distributions that are taxed, that have been taxed as income at the corporation level, but then also taxed to the taxpayer once the taxpayer receives it in their tax return. If cash is distributed when they have a positive tax basis, the distribution effect represents distribution of profits that have been previously taxed, return of capital that's previously been contributed to the partnership, or it's a distribution of the cash the partnership borrowed, or some kind of combination of the three. And it's kind of interesting. Due to the recent tax law changes, one of the big things that's happened, there's been a much bigger emphasis on the purpose of why an expense, distribution, income, and all that sort of stuff has happened. It's not that there wasn't one before, but I at least, and maybe this is just a personal perception, but I feel like for example, when we have an interest deduction, in the old days, like if you took home equity loan, say you took out a home equity loan for, I don't know, say $50,000, and you paid interest for $4,000 on that home equity loan. It was very easy for a lot of accountants, CPAs, and tax preparers to just go ahead and throw it on Schedule A and move on. Now that it's no longer deductible, now we have to go back and we have to do a lot of soul searching to find out, hey, what was this interest actually used for? And if the interest was used to pay for a business investment, well, then it's technically business income or as business deduction. You should be able to deduct it on that portion. Now, if you have a Schedule C client, this is easy. You just move it from Schedule A to Schedule C, done. It's not a big deal. Gets a little trickier when you're talking about a partnership. And so normally what ends up happening is that we'll do it where they say, look, goes to the partnership level, partnership gets to take the deduction off of it. It's seen as a contribution to the partnership. And then what happens is that and then the taxpayer will actually receive their portion of that deduction. Now, generally, and like I said, there's a few ways you can do this. You can do it the way I just described it. You can also do what's called a special allocation. So you say, hey, look, take the flower shop example I used in the last video. You got 4 people. You got one person who does all the cash, and you got 3 people who actually do all the work. And they go and they get a loan from the bank, and the person who actually puts all the cash in says, I'll be personally liable for all the interest. And by the way, I'm going to make payments on the loan. So what ends up, this can create a little bit of a mess because the partnership makes the payments on the loan. It's not a big deal because then, as it gets reduced and all that sort of stuff, it's kind of one and done. But if the partner is making the payments for benefit of the partnership, that actually becomes a contribution to the partnership for their loan payments, and then a loan reduction, and then any interest that person takes will actually be split between all 4 partners. Now, you can do a special allocation where the partners all come together and they say, look, the partnership's not really paying this, the investor is. So what we're going to do is we're going to specially allocate all expenses related to interest to that partner. And you can do this legally. You can totally do this legally. It's just that it has to be it either has to be part of the operating agreement or it has to be agreed upon by all partners. And there's sometimes where we run into this situation and we'll say, look, just out of fairness, this is how we recommend that this gets treated. Now, what'll end up happening sometimes is that one of the other partners will have another accountant that's involved and it's like, whoa, hold on a second. Yeah, he may be going ahead and making all these payments, but what if the partner's not legally liable for it? Say they didn't make an allocation that he would go ahead and be responsible for all the interest paid. And I say he because I'm talking about me because I was part of that example. But say I didn't say I would be personally liable for it. I'm just going to make the payments. So they may make a fight about it. Generally speaking, I think, and maybe it's just because we have great clients here. We don't normally see a whole lot of fighting that happens when a circumstance like that happens. And usually people are willing to do what they see as fair, and then they'll kind of go with that. And I think if you're making all the payments, you should get all the interest deductions. But we do still have to have agreement by all the partners. And if one partner wants to say no, then you kind of have to go in the room and start negotiations and figure out what you're going to do. Because what could end up happening is that all money bags here might say, fine, yeah, you're not going to give me the deductions off of it. I'm done. I'm not going to be paying for that anymore. So that could happen. Cash distributions deemed or actual in excess of partners' bases are taxable and generally treated as capital gains. Okay, so you could have distributions come out in 3 flavors. You have it to where they distribute the profits and it just comes right off of basis. You could have it, and when you say basis, you're talking like income type basis. So the partnership makes income. There's a distribution that comes out. The amount of the distribution is less than the apportioned income. It comes out of that income. It's not a big deal. Okay. Partnership's basis doesn't really change that much. I mean, it will, but it's going to go up by the income. It's going to go down by the distribution. Okay. The second thing you could have happen is a return of capital. Okay. So if you have a return of capital that takes place, what'll happen is, you have, say, $100,000 of apportioned income. You take out $150,000. That $50,000 that's in excess of that income will come out of the basis of contributed property that partner has made. So if they've made a contribution, say of $200,000 when they started the partnership, they have $2,000 of basis, they earn $100,000, they take $150,000 out. There's a $50,000 deficit that's going to remain that is actually going to get hit against their basis of contributed property. From a partnership standpoint, the tax treatment between 1 and 2, not a whole lot of difference. I mean, it's more of a recordation thing, and there could actually be some psychological effects. What ends up happening is, somebody's taking out cash more than the income. There might be some resentment from some of the other partners. And actually, I said psychological. I should say psychosociological because obviously there's a psychological aspect to it and a sociological aspect to it. And some people might think it's a little unfair, but that has nothing to do with tax. But it could have something to do with hurt feelings, and you've got to deal with that. The third option that happens is I take out cash in excess of my contributed amount and the income that's been apportioned. So if I have $100,000 of apportioned income to me, $200,000 that I've actually contributed to the organization, that's a total of $300,000. I take out a $350,000 distribution. That $300,000 is going to wipe out my basis. Then I have $50,000 of distribution in excess of basis. Well, here's the thing. Basis can never be less than 0. Basis will always be 0 or more. Therefore, if you have a distribution in excess of basis, the only way that you can work that out is that it has to be taxable to the individual. And usually what they'll do is that they'll, usually the way the rules work, it's going to be taxed as capital gains at the capital gains rate for that individual taxpayer. So if it's all money bags, could be as high as 20%. If it's the other partners and they're not making very much money, could be as low as 0%, depending on how that works out. So could be some opportunities for some tax planning. If you notice that one person doesn't have a whole lot of money and you want to pull something out of the partnership, you can do it, and you do distribution in excess of basis. Maybe they're at 0%. That's actually not necessarily a bad thing. I mean, it'll go on their tax return as a capital gain, but then, as additional income. Could affect other things though. So you want to make sure that you're actually running those numbers. And this is where, look, there's a lot of software that we buy in this industry, but I think planning software is worth its weight in platinum. I think you've got to be willing to give it an opportunity to be used and do all that sort of stuff. All right, so that's all I have to say about this video. Guys, we're almost at the end. I'm excited for you. All you have to do is watch one more video, and then you've done looking at my face this whole time. And I really do hope, though, that these videos have been very exciting for you. Put a lot of work into it, put a lot of investment into it, and I hope that it actually has helped you guys do a lot more learning. And because, my theory on this and why I did these videos to begin with is that human beings learn one of four ways. They learn either visually, audially, kinetically, or tactilely. Now, tactile is almost impossible to do in an accounting class. Tactile is like, if you think about it, people putting car engines together and things of that nature, and so you're actually touching and feeling things. Kinetically is basically where you actually do it. So that's why we do the homework. That's why it is to promote kinetic learning. And then, with the textbook, you can do visual learning pretty easily. But if you're a person like me who's I'm an audio kinetic learner. I actually had myself professionally tested. I'm an audio kinetic learner. So I learn by audio. I need someone to talk to me about this stuff. And so my hope was to have this available to you so that you could go ahead and get that set up, and then it would help you guys learn more. And I hope it's been that way. Anyways, guys, see you in the next video. It's the last one. I'm looking forward to seeing you there.